Assalamu alaikum and good afternoon, everyone. I would like to bring to your attention that we have started the recording for the session. The session is scheduled for 1 hour as it was disclosed on MSX. We will divide the session into two parts. First part will be for presentation and second part for Q&A. Appreciate to note down your questions for the second part. Now I will hand over to Mr. Saeed Al-Hatmi, the CEO of Alibank, to start the session. To you, Saeed.
Thank you, Habib. Assalamu alaikum and good afternoon. Thank you all for taking the time to attend this session today. My name is Saeed Al-Hatmi. I'm the CEO of Alibank. With me today have Anand, who is our head of strategy, and Habib, our investor relationship officer. Also, we have our CFO, Shiram, attending from a different location. To start with, this is the disclaimer statement is a matter of administrative and procedural matter. Would like you all to take note of its content. Habib, move on. Now, as stated by Habib, this session is divided mainly in two parts. First part, we will have a short presentations covering the macroeconomic overview of the Sultanate, then operating environment, the overview on Alibank, financial performance, and we'll touch base on the key focus area and the way forward. We will leave sufficient time for your questions on the second part of this session. If we can move on, Habib, to the first slide. This slide, basically, it's on the local macroeconomic. And as you all aware, Oman economy suffered from a prolonged downturn economic cycle. It started late 2014 with oil prices going down. And in the last couple of years, that's added up with the pandemic and restrictions and further reduction of oil prices to its lowest level toward of 2020. And now last week, exactly 2 weeks back, Fitch came up with the report on 15th of August, upgrading Oman sovereign credit rating, the LTFC and the IDR from BB minus to BB. This is a very good news for the country. It's again very good news for the economy as well. It's been a series of downgrade right from 2015-16 until we get to the BB minus rating. These are some numbers we put on these slides with regard to the GDP performance. I would like to state, depending on which agency is producing the number, there will be always slight variations between local agency, international agency like the Fitch and the World Bank, but the growth rate more or less are at the same range. Oman GDP is expected to grow by 3% or grew by 3% in 2020 and expected to grow by around 4% in 2022. That's that's compared to a contraction of around 5.6 in 2020 and 4.3 on 2019. The oil prices have rebounded strongly at the beginning of this year, and it's stable at an average of around 105. And also the oil production has substantially improved, and it touched 1 billion barrel per day this year and expected to remain at similar levels going forward. The oil price is expected to come down starting from 2023. This all has helped, as I said, the government to manage its finances and has resulted in a positive outlook in the overall to the Oman economy. As I mentioned earlier, the Fitch has already upgraded Oman sovereign rating with a stable outlook, and we expected other agencies to follow a similar kind of path. Now, this improvements actually came with at the back of improving oil prices, as I said, higher oil prices, as well as the government initiatives through Tanfeed and other programs conducted by the government in the last couple of years to reduce the debts and stabilize the revenue and the public revenues. So this has resulted in Oman is being able to reduce the external debts to a manageable level of around 40% of the GDP currently. Next slide again, it's just an overview of the operating environment in the banking sector. Similar to what we have seen, the banking sector also been through a difficult time throughout from 2016. But this prolonged downturn economic cycle has heavily and deeply tested the resilience of the Oman banking industry. And as you can see on these three graphs, the banking industry continued to perform well relatively. The total asset grew by an average rate of around 4%. And the customer deposit also grew by around an average growth rate of around 3.6%. That was total asset. And the loans and advances is 4.3%. So it's been challenging operating environment, especially in the last 2 years for the banking industry, as well as for other sectors. We have seen the impact in 2020 as across the banking sector when it comes to the specific financial metrics. However, we have seen a substantial improvement toward 2021 and the first half of the 2022 also. Similar trend in terms of overall better performance across the industry. Few points down there, it's in the operating environment. The operating environment has substantially improved with lots of COVID-related restrictions has been removed or cancelled, and then a strong rebound when the oil prices gave the economy a good cash flow and good revenues. The asset quality in the banking sector as a whole will remain a challenge. We had a holiday period for the last, I would say, almost 24 months now. And banks being asked to support the various sectors and various economies through the restructuring and deferment programs. Now, most of the customers will start paying off the installments and their dues shortly. And the quality of the assets will be tested once the repayment started. Having said that, we do expect the quality of asset to improve gradually from 2023 onward. Overall, the industry is well capitalized and have a sufficient buffer to absorb any shocks. The funding and liquidity has substantially improved in the last 6 months. In fact, toward the Q4 of last year, we have seen a good improvement on the liquidity, a good improvement in the local liquidity, especially the Omani Riyal. Having said that, with the Fed and other international central banks increasing their base rate, the LIBOR and other base rates has increased since then, and that additional cost is impacting the credit lines of various segments. Profitability and efficiency across the board, we have seen an improvement in the various financial metrics of the local banks. And as I said, banks continue to perform well in first 6 months of 2022 as well. With good improvement in the overall economic sentiments and overall economic activities and the enhanced in the public revenues, there is a better support coming from the government to the sector, which is passed also to other sectors within the economy. Move on, Habib. Again, it's an overview of Alibank. As you are all aware, we have Alibank converted into a fully fledged commercial bank in 2007. Currently, we have around 39 branches, including 17 Islamic branches dedicated for Ahli Islamic. We have organized our business around 5 business segments: retail banking, commercial banking, investment, treasury, and financial institution, as well as Islamic banking. Of course, within these business units, there is subcategories or sub-business units in each one of them. We are blessed with the strong institutional shareholding structure. As you can see down in the pie chart, Ahli United Bank is hold 35% of Ahli Bank, Al Hassan 14%, and Al Hassan Business Development 9%. Obar Capital, which is Invest Group, is around 8.7%. Civil Services 8.6%, and MOD Pension Fund 5.6%, and other investor around 18%. On the top right side is the key performance indicator. The total asset of the bank crossed 3 billion last year in 2021. That's up from 1.9 billion in 2016, give us an average growth of around 10% over the last 5 years. Deposit also grew by around 11.4% from 1.2 billion in 16 to around 2.2 billion in 2021. Gross loans also has witnessed a similar growth of around 10% from 1.5 billion in 16 to around 2.48 billion in 2021. And the branches, as I said, we've been expanding and growing our branch network. It went up from around 20 branches in 16 to 37 branches in 2021. And hopefully by end of this month, we will reach around 40 branches between Islamic branches and conventional branches. The other element is we've been doing very well in other financial metrics in terms of the return on average equity. Ahli Bank may be the best in the industry. We have the lowest, and we'll continue to have the lowest NPA ratio in the industry. Our cost-income ratio, while we are investing in expansion and in the digital transformation, remain relatively low compared to the industry. We were the first Islamic bank to launch online onboarding of our customer, and it's recently we have also launched the Tamkeen, which is the crowdfunding platform of our business segments. The way, as I said, we organize our businesses around 2 main groups: the retail banking and the wholesale banking. On retail banking, of course, we are focusing on the offerings of our product and services to the customer. We have dedicated teams to serve retail, private, and premium banking customer, as well as wealth management. We have, as I mentioned earlier, around 39 branches. 17 of them are dedicated for Ahli Islamic. And we continue to invest in the digitalization and digital transformation. Expansion going forward also will include digital branches, and we are in preparation of opening more digital branches shortly. On wholesale banking, we do have various segments within wholesale banking, including corporate banking and SME, the treasury and financial institutions, as well as the investment banking. The Alibank is known for its footprint in the corporate banking, and it's always been a strong presence. And we have been working with various clients in different industries with our structured solutions and products. So we have a dedicated team for various sectors within the corporate banking. We are focusing on those sectors where the government is paying a close attention and attention in the development in line with the Vision 2040. Treasury and financial institutions, they do provide comprehensive packaging and services to all the clients, including corporate, commercial, as well as the government institutions. The FI continue to be our global relationship arm. We do deal with the other financial institutions across the region as well as in other markets. Investment banking, we recently scaled up the investment banking activities. We've introduced a few new segments and services there. Our corporate advisory team has a good track record. Our asset management team also, and we have been recognized also even in the brokerage divisions as one of the leading player in the MSX. Down there is just the total assets and other financial metrics. Habib, if we can just bring it a little bit up. The total assets of retail banking remain stable of around 730 million across. The net operating income is improving from 22.7 million to 28 in 2021 and 14.6 million already for the first 6 months of the 2022. The wholesale banking total asset grew from 1.9 billion to around 2.3 in June 2022. And the net operating income has also witnessed a good growth from 48.8 million in 2020 to 54.2 million in 2021. And we already at 30.1 million for the first 6 months of 2022. Moving on. This slide is on Ahli Islamic. We have our Ahli Islamic banking introduced right in 2013. We currently have 17 dedicated Ahli Islamic branches serving institutional, corporate, SME, and retail customers. All of these our offering are in line with the central bank and the Sharia regulatory framework. We have seen a very good growth in the Islamic banking industry over the last 7 or 8 years, and we continue to grow our portfolio in Ahli Islamic. The total asset reached 493 million in June 22 compared to 475 in 21 and 394 in 2022. That's roughly a 16% cumulative average growth rate. In the financing also, it grew by around 11% and it stands at 420 million as of June 22. Customer deposit, where we have a substantial and a very remarkable growth in the last 2 to 3 years. It reached around 423 million. That's a 30% growth over the last 2 years. The contribution from the Ahli Islamic continue to be strong and improving. We have a 12% operating income coming from the Ahli Islamic, and the share of total assets stands at 16.2%. That's a very sizable portfolio. The focus going forward is on the expanding the retail side of the Ahli Islamic through a wider network, whether it's physically or through the digital branches and leveraging on the technology. This is the consolidated financial metrics for Alibank as of June 2022. The gross loan grew to 2.58 billion compared to 2.47 in December 21. That's a 4.1% growth. Total deposit were at 2.2 billion as of June 22 compared to 2.18 December 21. That's again 1.4% growth. Operating income grew by around 13% from 40 million to 44.7 in June 22. The net profit achieved during these first 6 months of 2022 was 15.8 million. That's an 18% higher than the June 21 of 13.3 million. These are some indicators and metrics on the operating performance and profitability. Our NIM continue to grow. It is 2.3% as of June compared to a 2.2 in 2021 and 2.1 in 2020. That's a 10 basis improvement in the overall NIM. Cost to income ratio is stable at 43%, despite the investment we made and we are making on the branch expansion as well as the investment in the technology. Return on average equity, as I said, is the best in the industry at 10.6, and the return on average asset at 1%. Other income to total income is 20%. It's up from 15 or 16% in 2022. The capital adequacy ratio remain healthy at 15.5, well above the regulatory requirement of 12.25%. We have a good room, but we are considering options when it comes to the further enhancing our capital base. This is analysis of the deposit and loans. As I said, last few years, though they've been very challenging, Alibank recorded a strong growth in various business lines. Total deposit grew by almost 10% as a cumulative average for the last 3 years. This growth came mainly from retail side, but it's also from other business units. And this is in line with the objective we have set for ourselves in terms of expanding the retail deposit base, retail contributions, as well as widening our overall clientele base. The gross loan and advances is also grew by around 9% from a 2.2 billion in 2020 to a 2.5 or 2.47 in 2021 to 2.58 billion in June 2022. Most of this growth are coming from the wholesale banking, the corporate banking, mainly the retail portfolio, the retail loan portfolio being relatively stable over the last 3 years. And most of these growth are coming from the wholesale banking. We do expect that to continue in the 2023. The deposit mix has substantially improved from 24. The retail contribution improved from 24% to 35% in June 22. The last one is on gross loan composition. We have almost a 30-70 split between the retail and the corporate banking. This gives the bank a very good headroom to grow the retail loans further in the coming years. Moving on to the credit performance. Last 2 years, especially 2020 was a challenging year in terms of the performance of various sectors. That has resulted in an increase of the default or the expected default across the industry. Having said that, we have maintained the NBA at 3.4% in June 2022, compared to a 3.2 at the end of last year and 2.9 at the end of 2020. These are moderate increase and expected in such an operating environment. Having said that, this is still way better than the average ratio we see in the industry. Moving on to the stage one, around 81% of our balance sheet classified under stage one. This has been stable over the last couple of years. Stage two, we have around 15.7% classified in stage two. And in stage three is around 2.7%. So again, comparatively, we have a better kind of position when it's come to the stage three and NBA compared to the average industry. These are, to say that, Habib, these are kind of relatively healthy indicators giving the prevailing market conditions. We have been managing the portfolio, and this is maybe a reflection of the very broadened approach, credit policy we have been adopting in Alibank since inceptions. Our performance in these lines being very consistent and very stable. Our portfolio remain of high quality by any comparison in this market. Next, Habib. So we come to the key focus area, and I think it's more or less is a conclusion of what I have said. We are on a growth mode. Our strategy is a growth strategy, and we will continue to expand our deposit and customer base. We are investing, as I said, in expanding the branch network. We are investing on the digital transformation initiatives. So that's the mission. In terms of the second element, enhancing the fee income. This is to diversify the revenue streams and also to upscale certain business units. We've discussed briefly about the investment banking, the private banking, and other fee income bases. Prudent growth, we will continue to grow our assets, our loan book in a very prudent manner. There are absolutely no change in our credit norms or credit policy. We've, we are very flexible and very agile when it's come to addressing the existing or the current market situations, but we remain very conscious about the ensuring the quality of the of our asset book. The digitalization and digital transformation, the bank has embarked on a strategy in last year on the digital transformation. We have already delivered a key projects I have mentioned about the online onboarding of the clients. We were one of the first banks to have the capacity and to onboard clients digitally, and we were the first bank in the Islamic side. So we continue to leverage on technology. We continue to collaborate, and we have launched recently the Tamkeen in collaboration with the fintech. So we are already seeing the benefits of our investments in the digital transformation. Last but not least, it's just a reminder and on the way forward. Asset growth, as I said, we are a growing bank. We have consistently delivered a growth ratio well above the industry. We will continue, to perform in these lines. We continue to expand our deposit mix and deposit base to ensure that we have a wider and a more diversified funding base, enhancing the fee income through introducing of various services and enhancing and scaling up the existing businesses. A digital transformation, we already, the mission is on, and we have a full programs being blessed by the board on the way forward with the digital transformation roadmap. We continue our efforts to improve efficiency, to enhance our customer services, to improve on the STBs and the turnaround time to ensure that our services and products remain competitive, relevant to our customer. With that, we are ending this presentation and we'll leave the floor now for the Q&A.
Anyone want to ask any question? Yes, Aisha, Zaya Hassan, you raised your hand first. Please unmute yourself and go ahead.
Assalamu alaikum and good afternoon. Thank you very much for hosting this call. My first question is regarding the credit conditions on the ground. What kind of credit growth are you expecting, let's say, for this year and the next? And which sectors are you seeing credit demand coming from or recovering from? We understand that in some sectors credit demand is picking up, but if you can just shed some light on that. And my second question is about any plans for capital raising.
Thank you, Aisha. We do expect the demand on the credit to pick up toward end of this year and next year. Overall, I would expect a growth slightly higher than the last year. It will be still a single digit, but it will be definitely higher than the growth we have seen in the 2021. In terms of sectors, we are seeing demands in tourism. We are seeing a demand in agriculture. We are seeing a demands coming from even manufacturing as well. So there is good activity started, at the beginning of this year, but still most of those projects still to materialize, and then for banks to start extending the credit facility. But Overall, we do expect credit growth in 2022 to be better than the last year. With regards to the capital, we have last week we have concluded, or we have closed the 75 million 81 bonds. Last year, beginning of last year, we had 35 million right issue. We will continue to make all possible efforts to enhance our capital base. But as of now, there is nothing to, there's nothing firm for me to share it in this forum. Having said that, our capital adequacy ratio was just presented at 15%, well above the 12% regulatory requirement that gives us a sufficient room to grow our businesses in the coming years. So there is no constraint on the availability of capital for us to grow our business.
That's great. Thank you very much.
Okay, moving to Abbas Musalmi. Abbas, please unmute yourself.
Good afternoon, gentlemen. Thank you very much for the presentation. So very informative, and appreciate your time. Just a few questions. My first question was on the ROE. I think you mentioned the ROE, but the numbers that you shared of 10.5%, I don't think those are adjusted ROE. So the way we look at ROE is net profit after perpetual interest, and then we divide it by common equity. And in that sense, it's fair because perpetual interest comes with an explicit coupon. And when we look at that, Alibank has been a solid performer. But at the same time, your ROE is around, if I look at adjusted ROE, it's around 7.5%, 8%. And the sector leaders are close to 10% on that metric, which is net profit minus perpetual interest divided by common equity. And one of the ways to enhance and you very nicely touched upon your sort of outlook for the bank in terms of where your focus areas are. And I completely agree in terms of to enhance ROE, that's where you'll have to focus. But how challenging will you find, for example, your CASA mix, okay? Your CASA mix is lower than, let's say, HSBC, Bank Muscat, NBO, but there's a relation between CASA mix and branch network. So when you look at each of these focus areas, or for example, the fee income part, if you look at fee income, Alibank is around 20 basis points on total assets, where the sector leaders are some, as high as 80 to 1%. That fee income upon total assets is around that big. So there is an opportunity, but this is like a 3 to 5 year plan, right? In terms of to enhance, the ROE through these focus areas. I mean, in the sense, how many years are you looking at as on a strategic way to actually achieve ROEs of the sector leaders? I mean, that's my question.
Okay, thank you, Abbas. With regard to the adjusted ROE, you are right. The one we have presented here is the return on average equity. It's just without, any adjustment. It's just straight comparison. On the retail, yes, it's not easy. The retail business, it takes time to grow. It's been a 3 years plan. We have started this in 18-19. And as I said earlier, maybe if we go back to the retail numbers, we have seen a substantial growth in our retail portfolio in the customer base as well as on the retail on the deposit side. It started when we started. We were around 18-19% in 17-18. And now we are at 35 retail contribution. So if you look at the retail contribution today, we are at par with the industry. With regard of CASA is actually where you have maybe a higher institutional and corporate deposits coming on the call account and the current accounts. Those are not necessarily a low-cost deposit. They help the banks in terms of the diversifications, but in terms of the concentration risk may not necessarily reduce the concentration risk. Having said all of that, it's not a 1 year mission. We continue the efforts in terms of expanding our retail network, our retail client base, as well as expanding in the low-cost deposit and CASA as well. So you are absolutely right. It's a long-term mission. It's not happening in 1 year. And the results what I have presented today, we discussed, is the results of the last 3 to 4 years efforts in developing our retail businesses.
Thank you for that, sir. And do you have an adjusted ROE target, the way you benchmark your KPI or the team's KPI in terms of where would you like to reach in next 3 to 5 years?
A specific number I don't have, but we have the CFO if it's handy with him. Hiram.
Hi, Bas. We don't have specific numbers as such in target, but the thing is to improve the revenue, as the CEO said, in terms of overall increase in the fee income, which will contribute to a higher returns to the shareholders as such. So this is not a specific number. It's just an overall income growth that we are targeting for the return on the shareholders.
Sure. Thank you. Point well taken. I have another question, sir, in terms of the consolidation that's happening in the sector. There's already, one that's happened. There's, a second one that very, very likely to happen. How do you as a senior management view this consolidation? And do you take a proactive approach where, some consolidation comes from the board, sometimes maybe the management initiated? What's your view on the consolidation? How do you see Alibank playing a role in this in the next 2 to 3 years?
I mean, as a broad statement, consolidation in any industry is good. We are aware of the current discussion of consolidation between local banks, and that's a very positive move. So that's my first statement on this. Second is Oman market is relatively, concentrated in a way. So we need to have enough number of banks, big banks, that they can support the economic growth. But also you don't want to have a very small number of banks that impact the competitions and the innovation going forward. So there is kind of this thin line of striking a balance. Having said that, I think the move, what is currently is happening, the discussion in the market is very healthy. It's very good for the industry. It's very good for the economy. With regards to Alibank specifically, as I said, we are on our mandate from the board is to grow. So we are in a growth phase. We are in a growth mode. We are expanding our businesses across various business units. We've talked about the retail, but we're also doing lots of work in other business area, in the investment banking, in the corporate, the SMEs. So that's the mandate we have from the board, is to reposition Alibank, to grow our presence in the economy.
Thank you for that. That really helps. I hear you loud and clear. My question, I don't know if you'll be able to answer this because it's more at the shareholder level, especially now that Alibank no longer has a management contract with Ali United Bahrain. But being the majority shareholder, I'm sure you're aware that KFH is going to acquire Ali United Bahrain. Now, KFH is an Islamic player. Do you see any impact from the shareholding change on Alibank Oman? Is there a sort of talk from the board to go Islamic, or maybe the shareholders will have to figure another way out, which as management you don't have a comment on?
Again, thank you for that. Alibank, as you rightly said, is our biggest shareholder and being our strategic partner for the right from 2007. They continue to hold a 35% of Alibank. We continue to receive the full support from the AUB and from the other board members. Alibank is a listed entity, as you are aware, in the MSX. Changes at the shareholding level may not necessarily have any operating impact on Alibank Oman.
Okay, well, that's your comment on that. And my last question is, you already sort of answered it on the capital adequacy part, where you said you're very healthily capitalized at 15%. But as the investor community, the capital I'm looking at is Common Equity Tier 1, and it's no secret that Alibank has been growing higher than sector growth for the last many years, and that's the reason you've probably come to the market thrice in the last 4 years in the form of rights issue. And now, from what I heard you on the call, there is an aspiration to be even more growth focused, and the board has given you and is working with you on that. So how do you, so it's only a matter of time that you're going to come and, raise Common Equity Tier 1. I mean, the numbers are in front of us. You're looking at 10% odd Common Equity Tier 1 ratio. So my question is what, according to you, what's the better strategy? Do you keep coming to the market every year or every 2 years and raise rights issue? Or do you look at one big rights issue or a private placement, which is going to, sort of enable you to achieve your growth ambitions? Because you clearly are in the market to grow your books. You mentioned that on the call. So how do you sort of look at optimizing capital rather than coming every year, doing one big issue or doing a private placement?
I think we said the word optimization of the use of capital. So we've been receiving tremendous support from our shareholders. As you rightly said, we came several markets and we went to the shareholders several times for enhancing the capital base, and we have received the full support from the shareholders. So is really a striking balance between being very efficient in terms of return on your investment, return to equity to the shareholders, and also ensuring there is sufficient room and there is a capacity in the capital base for us to grow our businesses. And we are quite happy with that kind of striking balance. We have enough capital to grow. As I said, we will be going to the shareholders at the right time, asking for additional capital, but that will be a business case. As soon as we see a business requirement for us to further enhance our Tier 1 capital, we will approach the shareholders. Now, being big or small is really depends on the efficient deployment of the capital. As I said, we've been having a very stable shareholding structure. There's not much of swings happening, and have a very clear understanding between the board and the shareholders in terms of the support. So we don't see a need for us to go and unnecessarily, get kind of capital that will not be efficiently deployed. Having said that, and you are absolutely right. As we grow, we will require additional capital, and that will happen. Now, will that happen toward the end of this year or early next year is depending on various factors. One of them is really the business growth and the opportunity we see in front of us. We'll continue to assess that. We have a healthy dialogue with the board, and we will approach the board and the shareholders in the right time.
Thank you very much. Really appreciate your comments, and all the very best to you. Thank you.
Thank you very much.
Okay, next, Bishan Bala, if you can unmute yourself.
Hello.
Yes, please.
Thank you so much for your presentation and all the answers so far. I had a couple of quick queries. We've been monitoring. I'm calling from Vision Asset Management. We've been monitoring the growth in the restructured loans, and the restructured loans stood at 75 million as of 31st December. They grew to 177 million in March, and as of June, as per your disclosures, they've jumped to 332 million. But that, as a percentage of your loans, is almost 12.9%, which is clearly the highest in the sector. If you could just comment on the same.
Yes, this goes back to the one is the current situation, or the situation we've been through in the last couple of years. Now, restructuring in itself, especially given the current market condition, is not bad. In fact, aligning the new cash flow or the cash flow with the new reality and the new repayment for these facilities is stabilizing the performance of these assets going forward. So there is different approaches. You shy away from the situation, or you address it, upfront. We've decided wherever we feel the business model or the cash flow where those facilities were granted no longer is possible for the customer to continue in a similar kind of repayment scheme. We've been discussing with our customer for the last 2 years. To a certain extent, we have concluded that exercise actually toward early of this year and last year, and that's bring the whole issue of COVID, to a better conclusion. Now, I've not looked at the industry, and I don't know how far we are compared to the industry, but what I can assure you, those accounts continue to perform. This is a broadened approach we have, taking in Alibank. There is no point of kicking the can, 6 months or 12 months down the line. There is a substantial shift in the operating environment, and we had to align ourselves as well as the customer commitments to the new realities. So from my perspective, I see that as a positive, that we are addressing the issue up front. And as I said, we don't expect, in fact, as of today, we won't have much of restructuring going forward.
Okay, so to take your comment further, the moratorium extended by the CBO till September 30th should then have a very limited impact in the buildup of restructured loans in Q3 and Q4. Would that be a correct assumption then?
Hopefully, because all those restructuring is taking into consideration the post-COVID realities.
Noted. Thank you so much.
Thank you.
Any other questions? So I think any closing comments?
Okay, if we don't have any question, then I thank you all for attending this session. And hopefully we'll see you in 6 months' time, inshallah. Thank you very much.